Big welcome from me. I'm Nigel Green. I'm a CEO of deVere Investment. So we, as a company, have an investment banking license. I'm currently in Mauritius, and that allows us as an organization to be able to access products that actually wouldn't be available in the normal retail space. So today you got one of the top fund managers in the world, Chief Investment Officer at Coolabah, who's got some strong opinions, Matt. Okay, so we're going to be interested to hear his opinions on 2025. Matt, okay, obviously runs Pacific Asset Management in the UK, so FCA regulated. Okay, he's going to be prim and proper and try and keep me and Chris from fighting if we're going to argue. But first of all, just from me, just to look back on 2024, because the title of the webinar is 2025 going to be any different than 2024? And it's an interesting title because, you go into the new year, everybody's got new expectations, and a big happy new year to everybody from me, because we start the new year and we love it. Okay, it's a brand new year, brand new opportunities. We get started and then we go, okay, what's different? What are we going to do? Okay, in 2024, the S&P in particular was very, very successful with a return of over 25%. And the previous year had done 20%. Perhaps equities hadn't been expected to do as well. The recession was expected by some, although we did suggest that we thought equities were going to continue to do well. But if you actually looked at that and you looked at the S&P, particularly from October 2023, so if you go back just over the year when that run had started, then 10 companies give you 59% of the gain. Okay, so, are we exposed, right? We've got five main companies there. You've got NVIDIA that this morning rather, launched. I say yesterday, it was yesterday in America, but it was actually my morning, where they were talking about their new chips that they're actually developing. Can that growth really continue? Okay, or is one potential accident there and equities could fall? Of course, there's other asset classes, and when people think about investments, for those of you that perhaps not so experienced, just think when you're investing, you have a choice of various different sectors that you can invest in. So I'll just very quickly describe those. So people can invest via property, for example. So that's one that everybody's used to. It can grow, you can rent it, and of course you can have lots of problems if you do rent it out, but property everybody understands. Okay, then when we come to equities and we come to bonds, people perhaps sometimes don't understand. So a company, any company, can raise money by issuing shares, that's equity, and you share in the profit of that company. Okay, so you could hit the jackpot or you could hit zero. If that company does really well, the share price tends to go up. Yeah, they can also raise money. So a company can raise money by issuing shares, or they can raise money by issuing bonds. That's a fixed return. A government can raise money by issuing bonds, and you get a fixed amount. Okay, it doesn't change, right? The only thing that can go wrong is if the government that had given you the bond or the company that had given you the bond, something happened to that company. But you're actually a preferred person to receive. So fixed is less volatile. So equities can shoot the lights out, but bonds, nice and steady. Okay, then, all right, other alternatives, you could put your money into perhaps art or Bitcoin or one of those alternatives. And again, okay, maybe there's an opportunity there. We'll come back to it. It's a bit less traditional. And then you've got things like gold. Okay, actually gold last year performed really well. Most people, what have they got? Okay, they've got equities, strongly equities. We now had 2 years of positives. Are we stretched? Valuations are higher perhaps than they've been for many, many years. Are we now stretched in the equity market? Is there a point in taking the risk? Okay, or should you actually go with the fixed return? Okay, so Chris is going to talk about the markets, what his fund does. deVere has an exclusive to it in the retail space. So think he runs a massive money investment company that manages billions and billions, and they have 36 clients plus deVere with a 37th. All the other companies are people like institutions, pension companies. Okay, then we have gained an exclusive. Love talking to you, Chris. What do you think of the markets? What do you think of 2025? Okay, and all right, what should we do with our money?
Thank you, Nigel. Appreciate the opportunity to engage with you guys, and also good to see you, Matt. So my name's Chris Joye. I run Coolabah Capital Investments. We run about 10 billion US across, as Nigel mentioned, almost 40 portfolios, and we've built this customized strategy specifically for deVere Asset Management. And I'm just going to share my screen. This is the DVAM Smarter Money Fund that we've built for deVere. exclusively. And this is basically a cash plus solution. It seeks to beat the cash rate or bank deposits by about 2% per annum. In the last 12 months, or more specifically in 2024, this strategy delivered about 8.8%. So the Bank of England policy rate right now is about 4.75%. After fees, all things being equal, we'd be targeting just shy of 7%, with a yield that is also 1 to 2% above the Bank of England policy rate. If you're investing in the GBP class, the product is offered in sterling, euros, US dollars, Aussie dollars, Swiss francs, and other currencies. So the cash rate that I'm talking about will depend on the currency that you're investing via. If it's US dollars, it'll be the Fed funds rate rather than the Bank of England policy rate. So targeting 2% over cash or just shy of 7% net in 2024, we believe the strategy would have delivered about 8.8%, a target yield or weighted average interest rate on the portfolio. And I'm going to explain what we hold and how we generate returns in a moment. But the target yield is about 1 to 2% over cash. So that's going to be in GBP terms about 6 to 7%. And this is a strategy that only holds very, very highly rated, A-rated bonds issued by the safest companies in the world. Daily liquidity securities, the fund is daily liquidity. Coolabah's role is to trade those bonds to generate returns above the yield or above the interest rate that they deliver. Another feature of this fund, which is really important, is its floating rate. And what that means is, heaven forbid, if rates were to rise again, the interest rates on these bonds would also increase. We're not trying to bet on the direction of rates. So the yield on the portfolio will rise and fall with the cash rate. And that makes it, as Nigel explained, relatively low volatility or low risk. So we're daily liquidity, we're A-rated, we're targeting returns of circa 7% per annum from a very low risk asset class. How low risk is it precisely? To give you a sense, we'll come to this later, but it runs about a quarter of the volatility of the equity market. So volatility of probably around 3 to 4% per annum, rather than equity volatility of around 14% per annum. So a little bit about us. As I mentioned, we run 10 billion US, 36 portfolios. This is, as Nigel mentioned, the 37th. We trade about $500 million US of bonds a day. We're one of the largest bond traders in the world. In 2024, we executed $70 billion US worth of bond trades. We have a very large team of almost 50 professionals spread between now Miami, London, Sydney, Melbourne, and Auckland. Our products generally rank the highest in their sectors. So we recently won a $1.1 billion US mandate from a global allocator because they assessed that in global bonds, Coolabah had the best track record they could find. But whether it's in the Morningstar universes or the FE Fund Info universes, we would assert that we rank more or less number one in those sectors, depending on the interval you pick. We use a quantitative process to basically find cheap bonds that are mispriced, they're going to drive high returns. And I'm going to talk about that in a moment. As I mentioned earlier, the asset class itself has very low volatility. So the deVere Smarter Money Fund, historically, we assess, would have run volatility of about 3.8% versus global equity volatility of about 14%. So we're talking about 1/4, as I mentioned, of the vol of that large equity asset class. And Nigel explained, I think, very eloquently, precisely what we're talking about. So it's pretty simple. You buy a house, you put down equity or a deposit, $100,000 on $1 million house, and you borrow $900,000 from the bank. The borrowing from the bank is the debt. The equity is the deposit. When you look at stocks, you're just looking at the equity. But companies, be it Barclays or British Telecom or Verizon or Meta or Goldman Sachs, their capital structures, like your house, are debt and equity. We're trading the debt. You're probably more familiar trading the equity. And in this particular fund, we're really focused on the safest debt, the A-rated bonds at the top of the capital structure. So typically senior secured bonds, senior bonds, and subordinated bonds. We're not holding equity or hybrids in this fund. In terms of how we drive returns, in fixed income, most strategies are passive. Most bond managers hold to maturity. They're not actively trading the bonds. Coolabah's approach is actually quite rare and unique. And in fixed income, normally there's a really clear trade-off between risk and return. If you want more yield, you have to take more risk. And the way fixed income fund managers drive that yield is through three key levers: by investing in liquid bonds, or loans, or private debt, or high yield securities that you may be familiar with, and they generally have high yield. They also invest in securities that are very risky, that have high probabilities of default. Things like Thames Water bonds, Credit Suisse hybrids. All of our peers did these sorts of things, and unfortunately, both those experiences or exposures turned out to sour unfavorably. And then finally, they can bet on the direction of interest rate markets. Is the Fed going to hike? Is it going to cut? By how much? And so forth, and take huge interest rate risks. In the deVere Smarter Money Fund, and in all of our portfolios, we don't do that. We really specialize in trading the most liquid bonds in the world, about $500 million US a day. Right now, we're bidding 300 million euros as we speak for a bank bond issued in the EU. So we'll invest up to $300 to $500 million in a single security. But these are incredibly safe securities that are very, very liquid. And we don't take default risk. We really specialize in only allocating to the safest issuers on the planet. So we're not interested in that illiquidity or default risk. And then finally, as I mentioned earlier, we don't bet on interest rate markets. It's a mug's game. Nobody can get it right. The market's hyper efficient, the interest rate derivative market, very, very hard to get edge because it's all transparent. Interest rate futures are exchange traded. It's highly algorithmic. The quants have the edge. And there's also a fair bit of inside information insofar as central banks tend to be porous. Statistical agencies can also be porous. And everyone in the world's hacking everybody else to try and get an informational advantage. So if we're not drawing on liquidity, default, or interest rate risk, how are we driving returns? We're focusing on the big part of the market, the unlisted or so-called over-the-counter bond market, and we're looking for mispriced securities that are just bonds paying too much interest for their risk profile. So we want to find a bond paying 6.25% that should actually, according to our models, we have up to 80 different bond pricing models that we've built in-house, should only pay 6%. And when that yield goes from 6.25 to 6, Coolabah and you pick up a capital gain. And that capital gain, the analogy in equity terms would be like Warren Buffett looking for a cheap stock that is unloved, that is trading on a very high dividend yield, that's profitable and safe and cash flow generative. And then when the rest of the world reckons or figures out that Buffett's right, the stock will appreciate and the dividend yield will come down and he gets capital gains, he gets his alpha. And that's what we're doing in the bond market, finding those bonds paying 6.25% that should, according to our models, once we properly account for their risks, the credit rating, the maturity of the bond, where it sits in the capital stack, what type of company has issued the bond, the liquidity of the bond, the size of the bond, and so on, we can generate these capital gains that are independent of the yield that are another source of return. Now, you might say, and I'm going to show you how successful we are in respect of that activity in a moment, but you might say, why do these mispricings exist? The bond market that we trade is very different to the equity market. It's not listed on an exchange. There's about 20 trillion US of these securities globally, and they're traded bilaterally over the counter on a voice basis, literally using telephones. It's highly archaic or antediluvian. It's like shares before exchanges existed in the mid-20th century. And every one of those 80 banks that we trade with is like their own mini exchange, or what we call a dark pool. And bids and offers cross. That means we can buy off UBS at $100 and sell to Goldman Sachs at 125 risk-free. We can literally arbitrage the banks because it's so dark, it's so inefficient, and therefore the securities get quite heinously mispriced. To give you a sense of the inefficiency, if I buy $1 billion of US equities, everyone in the world sees the price and the volume instantaneously. And every algorithm is trying to front run or fast follow my flow, right? Whereas I buy $1 billion of bonds in, say, Australia, the prices are never reported anywhere, ever. The volumes are never reported anywhere, ever. So it's a completely opaque and dark market. Similarly, if I buy $1 billion of US bonds, the volumes are never reported everywhere, ever. The prices are reported with a significant delay, but there are ways for traders to engineer around that and not disclose any prices at all. The participants are very passive. They hold to maturity. Bond fund managers are generally paid passive fees. So an active bond fund from a PIMCO probably have 4,000 bonds in it. They're not really active. They're going to give you the index. And if they want to beat the index, they'll soup up that risk, the liquidity risk, the default risk, or the interest rate risk to get more yield. They're not looking for that trading alpha. The smart money used to be the banks, but in the 2008 crisis, regulators came along and said, banks, you need to de-risk in all respects. And that meant basically cutting principal trading or proprietary trading in all asset classes, equities and bonds, but they withdrew and the smart money withdrew, which created an opportunity for us. So that's what we do. I want to quickly show you the efficacy of what we do. Now, this is pretty granular right now, but I'm going to explain it very clearly and quickly. This is every new bond issue that we've ever bought since 2020. This is like buying IPOs in the bond market. So you're familiar with IPOs in the equity market. This is what we're doing in the bond market. On the vertical axis is return, horizontal axis is time. Every dot is a different bond market we're trading in. We're looking at the Aussie market, the New Zealand market, the Euro market, the sterling market, and the US dollar market. The US dollar market is the purple dots. And we typically, this is the first unusual thing, we only hold for 2 days, where UBS's global head of DCM or debt capital markets said Coolabah isn't the fast money. They're the fastest of the fast money. So we're hyperactive, super high velocity because we're looking for these fine, tiny mispricings. But we typically flip every 2 days. How often are we right and how often are we wrong? Well, our win rate is this number here. Basically, 92% of the time we get it right. And that includes the interest that we earn that the bond pays us over the holding period, over that 2 days. If we strip out that interest rate, we earn capital gains 88% of the time. That's the pure mispricing alpha. That's us finding a bond paying 6.1 that should only pay 6. What is the typical mispricing? It's actually that negative 10 number that I'm pointing to. That's 10 basis points. That is like us finding a bond paying 6.1 that then normalizes down to 6.0. That generates a capital gain of 0.53%. Now, a lot of you may be sort of equity-focused investors, and you may say, Chris, listen, I'm not interested in capital gains of 0.53%. It sounds trivially small, but we're getting them every 2 days. And so when you turn that into an annual IRR, that's actually really compelling. It's a 37.6% per annum return. And of that 37.6% per annum return, 3.9% is interest and 33.7% is capital gain. You might then say, Chris, well, why on earth are you only targeting, or why did you only deliver 8.8% last year? I can't put 10 billion US into IPOs every day. So we can't actually deliver you the IPO returns because we're trading the new issue market and we're trading what I'm about to show you, which is called the secondary market, not the new issue market. It's like you're going onto the share market and buying an old stock and looking for prospective returns. So we do that as well. And that's what I'm now showing you. This is now secondary trading. And in the secondary market, the numbers are all very similar. We win 86% of the time. We find mispricings 82% of the time. The typical mispricing is actually larger. It's 17 basis points, not 10. So that's like the bond yield paying a 6.17 and then going down to 6 and then generating a capital gain of this number here, 0.8%. But we have to hold for 47 days, not 2 days in the secondary market. With a new issue, with an IPO, there's a natural catalyst for repricing. In the secondary market, we're just hunting those mispricing. And I've got to sit down and wait for the Nigels of the world to say, Chris, you're right, or my team's right, the 50 people that work with me are right, and the 80 bond pricing models are right. And that 6.17% yield goes down to 6. So in the secondary market, we generate returns of about 8.25% per annum, of which interest is 2.6 and capital gain is 5.7. But if I was a PIMCO, Janus, or Wellington, if I was a big, global brand name, and I don't want to cast any aspersions against my peers, I have tremendous admiration for their hold to maturity styles. But nonetheless, if I was those guys, I'd be paying you 2.6% per annum, not 8.25% per annum. To get 8.25% per annum, you'd have to invest in Credit Suisse hybrids or Thames water bonds, and that's not what we do. So the alpha is tremendously valuable because it's generating very high total returns from an intrinsically super safe, super liquid asset class that's A-rated, that has a quarter of the volatility of equities. I mentioned that we've delivered about 8.8% per annum. These are our, over the last 12 months, these are our 1 year, 3 year, 5 year, 7 year, and 10 year returns. The blue bars are the cash rate. The yellow bars are our returns via this strategy that we've developed for deVere. And in the last couple of months, we only launched this product, the deVere Smarter Money fund, in the last month or two, so specifically on the 24th of October. And Nigel made a bold prediction, which I feel very uncomfortable with, I must say, because it's a very ambitious expectation from or for what are otherwise, humdrum bond managers like ourselves relative to the racy and sexy, equities and crypto world. But Nigel did say that he expected us to beat the equity market, I think, in 2025. I'm not sure we'll be able to do that, but nonetheless, since we launched the product, I'm happy to report that we actually have outperformed global equities. We've beaten cash global equities, and we've significantly beaten the bond market over this incredibly short period. This is the strategy performance pre-fees. I'm technically not allowed to talk about the fund performance because we have less than a 12-month track record, but that is a kind of primer. So in summary, what we're talking about is fixed income. It's an asset class that's much bigger than equities. I'm not sure if you have much exposure to it. If you don't have much exposure to it, there's a really compelling diversification imperative that I'll sort of amplify in a moment when I talk about macro. We would like to think that we're the best in the world at what we do. I can tell you that I meet institutional investors around the world every day, and I have never seen an insto investor that has said, Chris, we're aware of any peer globally. They consistently kind of feed back to us that what we do is unique, even though it's in inherently very, very simple. We're just applying a lot of quantitative technology, a lot of maths and stats to price bonds accurately. And we're just trying to get the final few basis points of pricing right on very safe, simple, and predictable bonds. We're not trying to price the complex bonds, the risky bonds. We're pricing the A-rated stuff, the AT&T, Verizon, Morgan Stanley, Barclays bonds, the top of the capital stack, not down the bottom of the capital stack. We're looking for mispricings in a very inefficient asset class. We're hoping or aspiring to deliver more than 200 basis points after fees above cash and give you a low volatility liquid anchor in your multi-asset class portfolio. So you should think of us as a bit of a cash plus liquidity bucket that when you're nervous about the rest of the world and other investments that you can seek safe harbor in. And let me just underscore one final point on the strategy. The S&P 500's dividend yield right now is 1.3%. Right now, we're paying yields of circa 6 to 7%. So that's the opportunity set in the context. If you're concerned about equities, you can capture very high interest rates on this strategy without the downside risk of equities, which brings me to that macro point. Should we be worried about downside risks? Let me just say this. The S&P 500 has delivered 2 consecutive years of total returns above 20%. This is a very historically rare event. The last time it happened was in 1998 and 1999. What happened, though, thereafter? What happened in 2000? What happened in 2001? If it's so unusual to see the US equity market punch out 20% returns for 2 years in succession. Well, I can tell you, over 2000 and 2001, the S&P 500 dropped a cumulative 20%. Intra-year in 2001, the S&P 500 fell almost 30%. You might recall that the late 1990s were very reminiscent of the recent period. There was a hell of a lot of hyperbole and rhetoric around a productivity miracle because we were having the tech boom and a tech revolution. But unfortunately, that preceded the tech bust, the tech wreck, and a US recession. So nobody really knows precisely what's going to transpire. But we have had a very narrow source of growth in the US equity market. The Magnificent Seven, I think, did 47% last year. NVIDIA itself accounted for about 20% of the S&P 500's total return and 25% of the NASDAQ's total return. And the risk that is, as Nigel again eloquently articulated, the risk is that those extraordinarily ambitious growth ambitions or targets are not fulfilled. That would be a sort of a macro question that we would pose to everybody, and Nigel and Matt. Looking ahead into 2025, I think our key focuses are the big questions. Will interest rates rise or fall? You'll remember that at the start of last year, the market was expecting 175 basis points of cuts from the Fed, yet the Fed only delivered 100. And arguably, they delivered a political 100. They delivered 75 immediately prior to and coincident with the US election. Very historically unusual. Usually, the Fed runs for the hills when it comes to an election. It stays well clear of it. But it is the view of many in markets that they were hoping that Harris and Biden would prevail over Trump. Given Trump's antipathy towards the Fed, he's publicly expressed views that he wanted to take powers away from the Fed and potentially remove Powell himself. So we had preemptive cuts that perhaps were not warranted. The Fed did cut again in December, but there were significant dissenting voices within the Fed in relation to that cut. And what we have seen in the latter part of 2024 is a reacceleration of global inflation, but particularly US inflation. We're seeing it in the data overnight, a reacceleration of European inflation. And the problem we face is this, and these will be my concluding marks on macro before I hand back to the guys. We face a world in which politicians are preternaturally spending like drunken sailors. The reflex of choice is to spend money to buy votes to win elections. We're seeing it all around the world. UK Labor, in Australia, in the US. Trump's going to run budget deficits that have really never been seen before outside of the pandemic and the global financial crisis. A budget deficit of 7 to 8% of GDP, according to independent modeling, worse than the deficits under Biden. So on the one hand, government spending is crowding out private activity. Most of the growth in the economy globally is through public spending. Most of the employment is through public hiring, not private hiring. And that's creating tremendous inflation. At the same time, unemployment rates are ostensibly very, very low. And then if you overlay that, or overlay on top of that Trump's policy platform, which is highly inflationary. If you look at the Peterson Institute modeling of Trump's proposals, they believe that US inflation will increase by 7 percentage points and that the Fed's interest rate profile will be almost 4 percentage points above where it would otherwise be if Trump were not in power. So you're talking about Fed interest rate levels that will be almost 400 basis points higher or 4 percentage points higher than where they would be in the absence of Trump's policies. So that tariff proposal and the sort of ensuing trade war is potentially toxic for US inflation and potentially for global macro. Now, juxtaposed against that, we have some positives. We have his deregulatory impetus, his proposal to significantly reduce taxes, and the equity market has taken a one-eyed approach to all of this. The equity markets focus on the positives, not the negatives. And you also have Elon Musk, an iconic revolutionary figure who's proposing to embark on radical fiscal reform, which could be really, really constructive and very, very positive for markets. But we have, therefore, very significant cross currents. And those cross currents are contextualized in the interest rate price action last year. On the one hand, short-term interest rates controlled by the Fed and other central banks, they did fall a bit. So short-term cash rates declined. But on the other hand, long-term interest rates last year rose very aggressively, and they've continued to rise this year. And so that is the cross current we're talking about. On the one hand, the market's concerned about inflation in the long term, and the market's worried about the long-term cost of capital. On the other hand, the central banks are trying to cut rates. The final thing I'd kind of maybe note here is that since World War II, the Fed has delivered 13 recessions and 3 soft landings in response to inflation crises. But 2 of those 3 soft landings ultimately ended up in recessions again. They basically hiked to combat inflation. They cut when inflation started to fall, but then inflation reaccelerated again and they had to hike again. And then you had ultimately a recession. The only soft landing we've ever had since World War II has been the mid-1990s, which was unusual because you had a huge recession at the start of the 1990s that created a lot of spare capacity in the economy. Wage growth was very weak and productivity was incredibly strong. But then you also had China exporting huge deflation or disinflation into the global product market by selling cheap goods that were subsidized by the state. So I think 2025 is a very, very complex proposition where we think that there's a real chance of a reacceleration of inflation. We think there's a real chance of a higher for longer rate climate. We think that will pose problems for cyclically sensitive sectors and also particularly for the riskier parts of the debt market, for the so-called private credit market, the subprime lenders who are lending to businesses that have high probabilities of default. And we think you want to stay liquid. We think you want to be defensive. We think you want to be up the top of the capital stack. You've just had 40% plus total returns from equities. The last time this happened, you ended up losing 20 percentage points and you saw a US recession. So at that juncture, that very positive point, I will hand back the baton to my esteemed partner, Nigel.
I mean, I think certainly inflation for me is going to stay high. Whether it's going to go higher or not is perhaps another question. But I think sticky inflation for me. So, okay, I'm kind of similar to you, Chris, in that I think that interest rates are going to stay similar to where they are at the moment. You could get stagflation, of course, which would be a problem in so much as you get an economy that's not growing fast. And you've got inflation and governments can't reduce interest rates because inflation has stayed high. That is a possibility. And of course, that would cause a problem for the equity markets. But then on the other hand, okay, just to argue the point, because I think we should, you've got AI, okay? And, we're going to go, everybody says this time is different. Okay, well, there's an element of this is different because there's no question that AI is the real thing, and you're seeing with Nvidia. Yes, it was the bulk of the run. It's an incredible company what they've actually achieved, and whether you want to go with Nvidia or you just want to go with that sector and what it affects in the world, potentially it could be deflationary. So you could actually have a world where you've got automation coming in. They're saying 37% growth per annum, according to Forbes, for the next 5 years. I mean, that's nuts. Okay, that's an opportunity that perhaps is once in a lifetime. But I do, and I said it myself, if Nvidia misses one of its targets or one of its profit figures by 2%, the shares are going to go woof, right? Because it's priced in. It's so optimistic, the pricing. But okay, how do we look at this world where we say, well, hang on a second, this is real, right? People are using it. There's people making profit out of it. It could be deflationary. Okay, there has to be some form of opportunity there, even if a lot of it's priced in.
I'm with you, I think, Nigel. I mean, there's a couple of things just to pick up on both of what you've said. I think the tech wreck, the 2000 crisis, the world's very different. I mean, and those
we did say it was different then, though, as well.
Yeah. I mean, well, those companies are very different. One, they're hugely cash generative. And in fact, in many ways, higher rate environment is great for companies like Apple that sit on billions and billions and billions of dollars of cash. The difficult bit, I think, within technology, and I'm not talking about the meme stocks, the not-profit stocks.
No. Some of it's.
But some of those big technology names is that they are almost seen as defensives Now, I mean, when we saw 2000, they were defensive. Everyone stayed at home. 2020, rather, everyone stayed at home. The slight difficulty is just how much do you pay? You don't pay 35 times for a defensive stock. Apple and many of these companies aren't growing like they would to. So you're paying sort of, growth sort of valuations for a company that's not growing, and you can't justify them for being defensive because you're paying way too much for a defensive multiple. So I think there are some.
Okay, Chris mentioned deregulation, which Trump will certainly do, and I hate the fact that we've gone very political in the world at the moment. By the way, no, we're talking politics all the time. It's nuts. Okay, but nevertheless, he will go deregulation, so that should help the financials, right? Okay, so that should help the banks. And he's going to push the energy industry. And if AI just continues at a reasonable growth, you're going to need to stack more energy. So there's a couple of sectors there that have some potential to do well, as well as the AI sector from an equity point of view. Property looks tough for me. Okay, interest rates stay high. Okay, it's not doing anything at the moment. I can't see that suddenly personally turning around. So I think it's a question of, do you want exposure to equities? And if you do, how much?
Chris, question for you. Where do you see, if rates are structurally higher, I mean, the funny thing is some of these companies like banks are in such great shape. And some of the companies that you've talked about, how you invest in the Verizons, the Metas, the banks, they're almost safer businesses than governments themselves in terms of their balance sheets. But where are we seeing things at the peripheral that are starting to crack? Down at that high yield, that private debt market. I know you've always been bashing the private debt market for a number of years now, but are these structurally higher rates having a real impact on these sort of things?
100%. I mean, the data is the data, and if you look at bankruptcy data in the UK, highest since the GFC, since 2008. US bankruptcies, highest since 2008. New Zealand bankruptcies, highest since 2008. Aussie bankruptcies, highest since 2008. So we're seeing tremendous stress on the periphery of the economy. You got to remember that we had a subprime crisis in 2008, whereby banks were lending to borrowers who couldn't repay their loans systematically, right? And regulators came along and said, you just got to stop doing that, and you got to de-risk your businesses. You got to stop punting equities. You got to stop punting bonds, which created an opportunity for Coolabah. So we stepped into that breach. But where did all the subprime borrowers go? Well, they stopped borrowing from banks, and they started borrowing from non-banks, and they started borrowing from the high yield bond market, from the market itself. You must remember that our esteemed peers, PIMCO, coined the phrase, low rates for long, the low rate for long paradigm. And many people between the period 2008 and 2021 felt that we were going to be perpetually and persistently in this low rate climate, and sort of set their finances accordingly. And then obviously we had the biggest interest rate shock in 100 years in 22-23. And PIMCO themselves have come out and said that 40% of these private credit borrowers, these are borrowers borrowing from non-bank lenders, is the best way to kind of understand them conceptually. They're borrowers who don't go to banks, they go to non-banks. 40% of those borrowers at current interest rates can't repay their loans globally. And the interest rates they're paying on their loans, the spread that they pay above the risk-free or cash rate, that spread is less than half of the minimum spread you'd need to lend to these illiquid, risky borrowers.
Why is that happening, Chris? Well, explain that. Why are we getting so little yield from high yield if the story is so miserable?
Yeah, so particularly in the private credit markets, which are a form of high yield, we've seen explosive growth. This is a market that didn't actually really exist for all intents and purposes prior to 2008. It was created by the dynamic of the regulator saying, we're going to put this huge, tough regulatory net around the banking system. We're going to make them government guaranteed. We're going to make them too big to fail. We're going to ensure they're de facto riskless, which is why I love trading bank bonds, because they're de facto riskless. And occasionally you see some problems with the likes of Credit Suisse, but you got to understand, as you may know, Matt, in 2021, we put a blanket ban on any long exposures to Credit Suisse. They blew up in March 23, and we were short selling Credit Suisse's bonds to profit from them blowing up in 2022. That borrower universe was forced into the arms of the non-bank lenders. And then the pension funds of the world, the sovereign funds of the world, thought this was a great idea. I can get these ostensibly superficially high yields from these private credit or high yield bonds. Or, another analogy would be Thames Water bonds. I can get great interest rates on Thames Water bonds as long as Thames Water never defaults, right? Or as long as Credit Suisse never blows up, I can buy their hybrid securities, which are some of their risk securities. And that was the trade, and particularly in the illiquid debt markets, because there's no liquidity and you can't trade these loans. there's no volatility. And there was a really powerful volatility arbitrage that the pension funds were reporting and capitalizing on. What I mean by that is rather than allocating to equities, which move around violently all the time, they could get 10, 12, or let's call it 7 to 15% returns from private credit with no volatility at all. The valuation line was a straight line until, of course, Thames Water defaults, and then suddenly it plunges. And what we are reading about in the newspaper every week now is these private credit funds blowing up. Like yesterday in Australia, the biggest metrics, $20 billion private credit manager. It's reported that it's had to take over a $750 million property development because the property developer's gone bust. And so now they've moved from being a lender to they're running a real estate equity investment. I actually had lunch with the CEO of this private credit manager a few weeks ago, and he took me to a restaurant that he now runs because he was lending to the restaurant. The restaurant went bust. And so now Metrics, this private credit manager, is in the restaurant equity business. And this problem is going to get a hell of a lot worse in 2025 and 6. If heaven forbid we do get a reacceleration of inflation, if Nigel's right and inflation is stubborn, recalcitrant, and sticky, and interest rates have to remain high, or again, heaven forbid, we go through another hiking cycle, these riskier parts of the economy are absolutely cactus. And people are gambling and they're betting that there won't be problems, and they're betting on central banks bailing out these borrowers with deep rate cuts, but we're not convinced they will materialize.
The interesting thing about the private credit markets is because they wanted to ring fence the banks away from this. It doesn't also make banks incredibly cheap. I mean, I think JP Morgan, you can buy on 12 times earnings. So the equity is cheap on the banks. But the interesting thing is the reason why they had to ring fence it in the private credit market is because the governments don't want to bail them out. And whilst they're part of our infrastructure as a publicly listed company like a JP Morgan, they had to bail them out. But actually in the private credit world, no one's going to bail them out because there's no societal obligation to bail some private equity or private credit manager out that's got a massive...
So Chris, when you're analysing a company that you're going to buy a bond in, or you're buying can't fail or too big to fail. Okay, what's the structure that the team go through, just broadly speaking? Because you're obviously aiming at the very, very top companies. What's just a very outline of the process to why if there was a flight to quality, if there's lots of failures, by the way, in the world, just for everybody else, then people will go for quality. Chris is trading quality. How does he measure quality?
Yeah, so the first thing is we only invest in what is called the investment grade bond market. What does that mean? It means that technically the bonds are rated BBB to AAA, but it's the safest part of the bond market. But the truth is there's lots of dogs and stinky stuff that are still in that investment grade universe. And there's 5,900 high quality investment grade bond issuers globally. We only allocate to 600 to 700 of them. And basically we apply a bunch of different qualitative and quantitative filters to really find what is a simple aspiration, somebody who's government guaranteed. So a business that's explicitly government guaranteed. We love those businesses. So it might be a state-owned business. Businesses that are implicitly government guaranteed. It might be a bank that has, for example, explicitly guaranteed bank deposits, which is their main source of funding. It might be a bank that has access to central bank liquidity, which is another sort of implicit government guarantee. And then we also look for oligopolies and monopolies, that businesses that are too big to fail. Verizon's a good example. The US could never allow Verizon to fail because it's one of its key telecommunications providers. And then our credit research team, which encompasses just under half a dozen analysts, then do invasive due diligence. And their credit research reports are up to 40 to 60 pages long. Bond issuers globally often come back to us. UBS said this to us recently and say they've never seen a bond manager do more invasive due diligence than Coolabah. So they're speaking to the CFOs, treasurers, CEOs. They're tearing apart the business model, looking for hidden risks. As an example,
when you're getting the funds, you're not only getting the people that are trading, but you've also got people that are just literally checking that company out backwards and forwards and making sure that everything is super secure. Which is what's enabling you to buy the quality and preferably buy at a lower price and make on the difference. Okay, I like it. Any questions, Matt? Okay, in the chat there that you want to pick on.
So there's a question from Karen. So with the economic uncertainties and shifts in global trade, once Trump takes power, how will the 2025 strategies differ to managing investment risks, buying bond funds, seize opportunities for investors whilst advising? It's a lot of what we've talked about. I think it is about being at higher end of the quality. Liquidity is going to be key. Maybe both of you. What do you think the likelihood is maybe give me a number out of 10, and 10 being extremely likely, 1 being not likely. What do you say the likelihood of a reacceleration of inflation? Actually, they don't. I mean, they were pricing at about 100 basis points of rate cuts next year, maybe not quite that
I'm
much.
sticky inflation, so
You're sticky inflation. You thinking no rate cuts next year? Or this year,
thinking
2025?
maybe one, but not many. Okay,
Not many.
sticky
Chris?
inflation.
I think the probability of sticky or re-accelerating inflation, they're more or less the same thing. It's, we're just talking about high inflation that's not normalizing to the central bank's target is, 70, 80% probability. We're already
So that
seeing
means
it.
you're probably not cutting rates. I mean, that means that probably rates are
Yeah.
staying.
I think there's a lot of
Move on.
inertia in there's a lot of inertia in central banking processes. So they may chisel out a few more cuts, but we're seeing, in the data overnight, a reacceleration in European inflation, particularly services inflation. We've seen very strong German inflation. I think the Fed has affected it's funny, the markets have more or less ignored it, but the Fed's affected a pretty massive pivot. Pre-election, they were like, we're going to cut rates down to 3%. They're at 5.25 to 5.5%. So we're staring down the barrel of huge rate cuts, which was, grist for the equity market mill, created an enormous amount of equity exuberance. We had record highs in the S&P 500. As soon as Trump won, literally the next day, they started signaling all bets are off. Like, we don't know what we're going to do next year. We don't know how much we're going to cut. We're worried about cutting too far. We're worried about where the normal or neutral interest rate is. So a profound change in the Fed.
Yeah, I mean, you've still got wage inflation. You've still got a world that's fractured.
Exactly.
Okay, you've got Trump coming in, so he's going to cut corporate tax. Okay, he's going to increase spending. It's inflationary.
Tariffs,
It's inflationary.
Yeah, deportation is inflationary if you can get away with it.
Yeah, you've got AI potentially brewing. It's going to be sticky, right? You got wage inflation. As long as you got wage inflation, okay, you're going to have real inflation. You got wage inflation, so you have to create mass unemployment to get rid of inflation.
Yes,
totally.
so that's I think it's a great point, Nigel. So if Chris, you talked about the default rates re-accelerating and some of the highest default rates we've seen in riskier companies. Why isn't this leading to a spike in unemployment? And if we see a spike in unemployment, then that has to be deflationary, and then they can cut rates. I mean, because
of a very simple answer, because of the public spending is creating so much public demand and public hiring. Most jobs hiring in the US is public hiring. 82% of all employment growth in Australia has been government hiring, and only 18% of it has been private hiring. So you're seeing this massive public spending globally crowding out private activity, but it is in and of itself the main source of inflation and wage growth. Like, public wage growth is much higher than private wage growth generally around the world. But as far as the economy is concerned, they don't really care whether it's public or private spending. They're looking at aggregate spending, and that's creating aggregate demand and excess demand that is greater than the productive capacity of the economy. Isn't Elon Musk going to
stop this? Isn't Elon Musk going to stop the hiring, and then there'll be no jobs created in the US?
Mate, so this is the curveball. Like, I'm listening to an audiobook, which is the biography of Elon Musk, and I encourage everyone to listen to it because he's an iconic, as I said, heterodox, revolutionary figure. And he's changing the world. Like, SpaceX is incredible. Tesla, likewise. I use Starlink all the time. You can now get Starlink in planes, 300 megabit per second download speeds at 45,000 feet. So I think he's an interesting one. Like, if Trump is able to, strike a durable partnership, a lot of people think that they won't last more than a few months together.
When they fall out, okay, it's not if, when.
Yes, exactly. Right. Will they last 12 months, Nigel? Will they last 12 months together?
I think he's a genius. I agree with Chris. I think he's a genius.
But do you think, are you in the less than 6 month camp? Trump and Musk?
I don't know. Okay.
You can't sit
I want to get out of politics if I can, really. Okay.
That's very true.
The world's talking about it. Okay.
There's another question that's coming from Benjamin. How does leveraging advancements in technology and AI to enhance investment strategies and portfolio management? Do you see these innovations playing a future in financial advice? Well, I guess there's two questions.
Start with
Nigel. AI, Nigel, is that going to make a difference to how you do deliver financial advice? And then maybe, Chris, is AI going to help you price bonds and your investment strategy?
Yes, I think it can enhance advisors, no question. So they can, you know, if we're doing a call like this, I haven't got AI on at the moment, but if I did, I could have a report instantly, and I could check it and then send it to the client super quickly. So I think there's lots of advancements, lots of things that deVere are doing with AI to help people. So I don't think it replaces. I think you always want to talk to a human. You want to trust. I think trust is super important and becoming even more important in the world. So I think that there's a great need for the final financial advisor to be talking to the person and explaining it. But I do think that a good advisor should be using AI 100%. deVere should be to helping us be more efficient, to be more effective, and to be able to give better service and look after clients even better than we do. So I think there's massive potential for us to be able to do more, but I don't think it replaces a human at the final touch.
On your question, Matt, to me, like, we use AI in our investment process and have done for the best part of a decade. So we use AI to credit rate all bond issuers globally live. So they're basically those models that we've built, those AI machines are trying to figure out what is the right credit rating on a security. And in fact, we actually bought about 120 million of Verizon bonds a few years ago when our AI models were saying Verizon should be an A- rated bond issuer, but at the time it was only BBB+ rated. We ended up convincing S&P to kind of put Verizon on watch for an upgrade. We also convinced Verizon management to change their public communications to encourage an upgrade. So yeah, AI is important. We use it right across our process, but I don't see it as all or nothing and replacing the species as such. I'm much more interested in the fusion of AI with people, whether it's through Elon Musk's Neuralink, or whether it's through just the collaboration of people and AI. Obviously, AI is coded by people, created by people, and we see it as a very, very powerful tool. Whether it can ultimately deliver on the hyperbole around the deflationary benefits and the productivity benefits, I think that's a really nebulous, difficult question. We had exactly the same story in the late 1990s with the advent of the internet itself. It's guys like us, maybe not you, Matt, but Nigel and I are a little bit older. When I was at university, there was no email, there was no internet. You're probably a couple of years younger, Matt, so you might have been able to capitalize on those innovations. But imagine living in a world, for many of you on the webinar today, the few hundred people who are still here, where you have no internet. I didn't have a mobile phone, no email. And that technology change, access to all that instantaneous information, I mean, that was profoundly important for arguably productivity, but we didn't necessarily see the productivity gains. And exactly the same ruse is being run with AI, that it's going to revolutionize our lives. I would suggest the internet.
Paperless world, where did that one go?
Yeah, paperless. Yep. Online payment processing, banking. Yeah, doubtless there have been productivity benefits, but there's also been productivity costs, particularly in the public sector. The biggest productivity dragger in the economy globally is actually politicians. So this brings us back to Musk and Trump and whether they can strike a durable partnership and that can revolutionize the US economy. I'm actually glass half full on that. I'm hopeful. And it may be as much Musk managing Trump and sort of catering to the vagaries of his personality in order to ensure that relationship lasts for a long time. But hopefully it does.
For him to manage all those big characters in a government. Okay, Chris, do you have any equities yourself apart from Coolabah? Okay, whoa, put him on the spot.
I have. It's a good question. I actually do. I have a merger arbitrage manager in the US, a group called Beryl. I believe is their name. And I have another global long-short equity manager in Australia called Bronte Capital. But I have tiny investments. I would say they're trivial parts of my wealth.
Most of your money is in bonds.
All my wealth is in the deVere Smarter Money Fund style strategies and in Coolabah equity. So I'm a big believer in specialization and just trying to drive wealth through my own human capital.
Nigel, can I ask one last question then, just before we wrap up? There's one question probably for both of you. I'll start with Chris. You cannot have a webinar with Nigel Green and not mention the word cryptocurrencies. It came into my head, and we've had two questions on it, and I'm going to address this question in a different way. So the first question goes to Chris. If risk assets are priced off government bonds, i.e. to work out whether a bond is cheap or expensive for a company, you have to work out what the 10-year, what the cash rate is effectively, and then what's it being paid over and above that cash rate. If central banks are disintermediated, because now people print Bitcoins and central banks are less involved, and actually we don't have a central bank, world, and therefore Bitcoin realizes its trillion-dollar valuation or whatever. What happens to bonds? I mean, is Bitcoin printing money? Does it affect the risk-free rate? Does it affect how you think about bonds? Do you think Bitcoin is here to stay? That's for you. And then I got a question for Nigel on where Bitcoin valuations are going. Put him on the spot.
Yeah, I mean, I don't see Bitcoin or cryptocurrency having wide-scale pervasive application across the economy. I mean, currently the users are sort of right at the perimeter of the economy. If you look at Bitcoin, it was promised to be an amazing medium of exchange. We don't use Bitcoin to buy anything. It was promised to be an inflation hedge, but in the biggest inflation shock in 40 years, it fell from $68,000 to $15,000. It was promised to be a stable store of wealth. It's the most volatile thing that exists. It was promised to be a diversifier. It doesn't diversify you from anything because it's very highly correlated with equity. So it's basically a risk proxy. What it is, and I think the use case for Bitcoin, the one remaining use case for Bitcoin is as a store of wealth beyond the reach of nation states, particularly if you live in a non-democratic country. There are 5 billion people that live in non-democratic countries who are looking for secure stores of wealth, and it is ostensibly secure. So I think the cryptographic and encryption credentials of some cryptocurrencies can be very, very valuable for individuals living in non-democratic states where they have concerns about rule of law, property rights, individual liberties, and the assurity and security of their own savings. And I think that's a really powerful use case for crypto. But it's not an inflation hedge, stable store of wealth, diversifier. And I also don't think it's cryptographically secure. Bitcoin is predicated on the encryption technology called SHA-256, which Satoshi Son in his white paper, when he wrote the Bitcoin white paper, the developer of Bitcoin, who we've never found and who still owns billions of dollars of Bitcoin, and who is almost certainly, in my view, just a proxy for Western intelligence agencies who created Bitcoin, because he's the only altruistic person who's never sought to tap into his billions of dollars worth of Bitcoin holdings. But he predicated it on an NSA technology. So the NSA, the National Security Agency of the US, created SHA-256. Now, its sole role is to break codes to steal secrets and protect secrets. So the NSA does not release encryption technology, which it did via SHA-256 publicly, which anyone can use unless it can break it. So there's no way in the world that Bitcoin is cryptographically secure. It's also vulnerable to things like 51% attacks. It's almost certainly a Western liberal intelligence honey trap, so to speak. There's a good reason why the Chinese don't allow it to be used in China, because they probably harbor the same concerns. But the objective, I think, for Western intelligence is, in an existential crisis, nefarious actors shift their wealth to the likes of Bitcoin, and then they can, if they want to, control it or appropriate it. But I think there's a use case for Bitcoin. And I do think it's a diversifier through that vector, that use case. But I don't think it poses any challenge to the Western monetary system, interest rates, or central banks. And I think central bank digital currencies will supplant many cryptocurrencies in terms of the conventional use cases as mediums of exchange and conduits for transferring money around the system. That would be my thumbnail sketch on crypto.
There we are. So I think that's not too dissimilar to some of the stuff that you talk about, Nigel. I mean, I guess.
No, agreed. I mean, I think it's not just democratic, non-democratic. I think it's democratic ones, because I don't trust any of the governments. So I think you're absolutely right. It's anti-government to some level. And maybe Trump's got a load of Bitcoin, right? Okay, certainly
he does. I'm sure he does.
Been appointed as a Bitcoin fan, so that's kind of like a coincidence. So all of a sudden, you got lots of people being elected that are all Bitcoin fans. So I think America will deregulate on Bitcoin. You can see Trump trying to even use dollars to buy Bitcoin. So I think there's upside, right? ETFs, BlackRock are pushing like crazy. That's a big machine to be backing Bitcoin. It's 100,000 today, give or take. Okay, I think 125 first quarter, and I think it could do 150,000 this year. I do think 100% with Chris, however, that it is really, it's the countries that really totally can't trust their government. I mean, why would you? You'd rather have a digital currency, if we want to call it that. limited amount, okay, that makes 100% sense to me to use it as an alternative currency, if we want to call it that. But even for me, okay, I asked Chris the question, you know, what do you have any shares? Okay, so I've got stock. So I like particular companies. I like some tech companies, particularly connected with AI, some emerging ones. I think the financial sector's got opportunities. I think there's even some value in Europe, where you've seen America massively valued, and actually Europe hasn't followed. So I think there is value in equities. However, okay, I do have lots of money in Coolabah, so I've invested in it. I think it's sensible for me, and it depends on the individual investor, but for me, I like 80% of my money steady, all right, in something like Chris, in a structured note, in diversified multi-asset, 80%, okay, minimum. And then I'll have a conviction investment, and Bitcoin might be a small percentage, if you want to call it that, of that conviction. I think that's going to happen because of this, and I'm not always right. I just think I'm always right.
We only remember the good stories, Nigel. That's the best.
Yeah. Well, you know, I talked about Nvidia before it did it, and okay, that was good. And we did, you know, Bitcoin, and last year I was talking about Meta at the beginning of the year, and that had a fantastic year. So, I mean, I think if you're in the business actively day in, day out, you get a feel for it.
Yeah.
So I think this year, Chris has articulated it, and so have you. Equities are highly valued. Okay, do you want the risk? And that's a personal decision, I think, for clients and advisors, you know, because there is upside for sure, but there's definitely downside. Okay, so, you know, you prepare for that. If not, then you need to diversify at a minimum, and you might want to go even more in a steady, good fund that is just going to give you high returns. I mean, why be in a bank account that's giving you 0 or 1? You know, they can go broke.
And you can't get anywhere near cash anyway. As you said, the bank gives you 0 or 1. And if you do, you have to lock it up in a product like this.
Well, Goldman Sachs is down 9% in equities this year. Yeah. Deutsche Bank say 10, UBS say 9% as well. Okay, well, if Coolabah can do 7 or 8, why would you take a risk on the 9? Okay, which these guys are saying they're going to do 9. Okay, well, why not reduce your risk and lose 1 or 2% maybe? Okay, maybe.
Yeah, I completely agree. Talking of risk, Nigel, I'll leave you with one thing. I was reading an article yesterday. It said that revenues of Tesla and BYD are the same. BYD is growing twice as fast as Tesla. BYD is on 15 times earnings, and Tesla is on 120 times earnings. So maybe emerging markets is cheap, although
there's opportunities in the market. You take your own risk. Tesla prices in Elon Musk, prices in, you know, robots coming through, prices in his genius, prices in the opportunity. Okay, but nevertheless, you certainly wouldn't put your life savings in it.